All right, good afternoon, everyone. Today it's November 12th, 2019, and it's roughly about 10 to 2 Chicago time. I thought it would take probably 5 or 10 minutes to go over the difference between what a limit order is versus a stop order. And not only that, how it relates to the CFRN trade setup and the training room, the things that we're looking at inside the market while Michael is talking in the training room. All right. A lot of questions pop up about it, so I thought it was time to get off the bench and create a small video on what it is and how to execute it. Okay. So that's what we're going to do. Like I said, it might take 5 or 10 minutes. Okay. But before I present, I have to go over the disclaimers. Okay. Again, I've been around for almost 25 years, and I really have seen the good, the bad, and the ugly when it comes to trading. So I don't take this lightly. And so that's why I'm presenting, taking a few minutes just to show you and tell you what the heck this is all about. Generally speaking, if you don't have a trading plan, if you're not using stop losses, if you're not engaged in the marketplace, if you're not watching over your trading account, and you're not in tune with what the market news is for the day, this disclaimer is going to hit you right smack dab in the face. Okay? So that's why I don't take it lightly, and that's why we talk about it up front. Okay? Secondly, this slide basically tells you or goes over the relationship I have with CFRN. Okay, because I am going to talk about things that are relative to their training room. And basically, they are a third party. They have a set of indicators, trading tools. They have some rules, and basically, their indicator set is built inside our trading platform. Okay, so if you're brand new, okay, and you're looking at this for the first time, what you're staring at right now is the dtPro trading platform. It's the same platform that Michael and Dwayne are using. All right, it's the same one that I support. Okay, it's the slingshot down below and the BBC and the MA1. The indicator set that you see here is property of CFRN. Okay, and with a few left clicks, you can have the indicators downloaded inside dtPro. There's really not a lot of heavy lifting. Okay, you have access to the training tools. You'll have access to the indicators. You'll have access to the platform while you're taking the trial. Okay, the demo, the data comes with it. It's all real time. Okay, so you'll see everything as it's coming through from the exchange. There's no delays. Okay, so it's really going to be a good test of what you can do and what to expect while you're on your trial during the training room. Okay, so my role is I support the platform, the indicator set. If you decide you're going to be a CFRN member and you're going to use the dtPro trading platform, I support the brokerage side of it too. If it's anything relative or sensitive to what's going on with the CFRN website and the videos and maybe the Logic 247 and the concierge trade alerts, anything centered around that stuff, you would reach out to CFRN directly. Okay, so again, before I present, I have to show you these the screens. Even though we're not talking about markets and making recommendations and telling you where to buy or sell things, this is more of an educational piece. I still have to talk about it. Okay, all right. We are going to talk about the difference between stop and limit orders. Okay, limit orders, as outlined, are placed at or below the current market price. So if we're looking at the gold market, the current market price is at $1461.20 right now. If I thought, hey, the gold market's going to go up, then buying a limit order would be an order to get long at or below the current market price. 1460.70 is below the current market price. If I was thinking, hey, I think the market is going to go down, and we know that the current market price is here at 1460.90, okay, I would place an order at or above the current market price. So in this example, I'm trying to short it at 1461.5. Okay, that's what limit orders are. Okay, we are placing orders at or below the current market price. Okay, now when you're pricing or placing a limit order, your price isn't guaranteed. Okay, so you're saying, hey, I want my price or nothing. The risk in doing that, placing that type of order, is that you run the risk of not getting filled. Okay, so why? What does that mean to me? So let's say if the market is at 1461 even, and again, you thought, hey, the market's going to go up. Well, placing an order, as we know, is we're going to place it at or below the current market price. Okay, we're trying to get it cheaper. Think of it that way. So if we're trying to buy it at 1460.40 and the market does go down to 1460.40, you're not guaranteed a fill. You're not guaranteed your price at that point. The market has to trade below that price in order to guarantee a fill or an execution. So remember that, okay? Just because the market trades down to your limit doesn't guarantee that you're going to be filled. That's the risk associated with it. It's nice that you're getting your price, and it's nice you might have gotten it cheaper, but you run the risk of not getting filled at all, okay? And then conversely, okay, if we're trying to get short and the market's at 1461 even, we know in order to place a limit order in, it has to be at that price or higher. So if we place an order, try to get short at 62, and the market trades up there and just taps 1462, that is no guarantee that you're going to be filled. And it's going to have to trade one tick through in order to guarantee that execution. Okay? Again, what's the risk on that side of not getting filled? Okay? So it's nice that your prices are guaranteed because you know exactly where you're going to stand in the market price, but there is that risk of not getting filled at all. Okay? So again, limit orders are associated with, generally speaking, they're associated with entry price, getting it at or below the current market price, or targets. A lot of times people are trying to get out at higher or lower prices depending on the direction that they're going in. And so you'll see a lot of times people placing limit orders as targets. And again, you'll see that in the training room. Michael does it a lot when he's trying to get his goal. Okay? So those are limit orders. Okay? The other side of it is stop orders. Okay? So what are stop orders? Stop orders are placed above or below the current market price. So let me break this down. If we're on the buy side, okay, then a stop loss would be above their current market price. Okay, buying it on a stop at 1461.30 is greater than 1416.5. Okay, so you're trying to buy it above the current market price. If we were trying to short it below the current market price, okay, selling it at 1459.70 is less than 1460.5. Okay, so that is a valid sell stop. So we're buying it and selling it above and below the current market price. All right, so why would anyone want to do that? Okay, couple things. Number one, stops are generally placed as a form of protection, a stop loss, stopping my loss from the position going against me, right? That's the common use of it. The second way, it can be used as an entry, okay? And inside the training room, we see that a lot with Michael. He's buying and selling as a way of entering into the market price, okay? Especially if a market is consolidating, it's going back and forth, back and forth, back and forth. And at some point you're thinking to yourself, hey, the market's it's going to break out of this range and go. Well, that's a good strategy. Okay. You can buy it above the current market price or sell it below the current market price when it breaks out of those two congestion levels. Okay. So again, stop placements are generally used to protect losses or to stop losses, but they also can be used as entries. Okay. So the big thing with that, though, okay, and what's a big difference between stops and limits is that the stop price, the price of the stop is not guaranteed. So again, if we have an order at 1460, that's where the current market price is, and we think, boy, if that gold gets up to 1461, I want to be long because I think this momentum's just going to carry it and it's going to pop. Okay, if the market trades up to 1461, that order then becomes a market order. So your price is not guaranteed. So you might get filled at 1461.20, 1461.30. So one of the personalities of a stop loss is, yes, the order goes, the market goes up to that price, that stop price, it becomes a market order, and your price is not guaranteed. What you're substituting is, hey, I just want it filled. I don't necessarily care where I'm getting filled at. I just think at that point it's just going to break out and go. Okay? So price isn't guaranteed, and one should expect, we call slippage. Okay? And then conversely, if we're at 1460 even, and we think, hey, if that market really breaks down to 1459, that is below the current market price. Again, if the market goes down and trades down to 1459, okay, your then stop becomes a market order, and the fill price, your stop price is not guaranteed. You're just taking the best price available. Okay, that's what that means. Okay, so you're substituting price, okay, for action for the most part. Okay, so remember that. Okay, so limit orders, your prices, your price that you're placing, that price is guaranteed. When you're placing a stop order, that price that you're placing the stop at, that is not guaranteed. Okay. All right. You just told me a lot of information, Burt. How the heck do I organize it and think about this, right? Here's a cheat sheet. Good way to remember this. Take a piece of paper and divide it in 4 spots. Okay. So we got 4 squares here. Okay. Label that horizontal line, okay, as the current market price. Okay. And then the left side here, the 2 boxes on the left-hand side, that's going to be your buy side. And then anything on the right-hand side is going to be the sell side, as I kind of outlined it here. Okay. If we know the current market price is this horizontal line in the middle, the top box here, top left, label that buy stop. Why? Because we're trying to buy it above the current market price. That requires a buy stop. Okay. The bottom left, label that as a buy limit because we're trying to buy it below the current market price. Okay. And then as we move to the sell side, okay, the top box, because we're trying to sell it at or above the current market price, label that box as sell limit. And then the box below the current market price on the sell side here, label that sell stop. So you're going to be selling it below the current market price. That's how I learned it 25 years ago. Okay. We took a piece of paper, we divided it up in 4, and that helped me recognize the difference between buy stop and sell stop. So hopefully that helps. Okay. Okay. How do we enter limits and stops on the DOM? Okay. This tower here, okay, this is called the depth of market or a DOM. This is where we do most of our buying and selling. Okay. The green area here is where we do any type of buying. The red area here is where we do all the types of selling. Okay. So if we think the market's going to go down, we're going to left or right click in the red. If we think the market is going to go up, we're going to left or right click in the green. Okay. The current market price is right here. It's outlined at 1459.60, 1459.70. Okay? So, as outlined here in our little cheat sheet, right? If we're going to buy the gold, and we're staring at the gold, and if we're going to try to buy it below at or below the current market price, okay, we're going to be in the green because we're buying, and we would left click. A left click creates a limit order, okay? So I'm trying to buy it below the current market price, so we left click in the green, okay? You're saying, hey, I want my price or nothing, okay? On the flip side, okay, staying in the green, okay, if the market trades up to, let's say, 1461, okay, it's above the current market price, okay, we are placing a stop. We're going to be buying it on a stop, whether it's an entry or it's a protective stop. The bottom line is, if the market gets up to 1461, I want out of my current position or I want in, okay, a new position. We right click in the green in order to accomplish that, okay? Right clicking above the market price. All right, now we're going to focus our attention on the sell side, okay? Sell side, we're left and right clicking in the red. So again, if we're going to try to sell it at the current market price or higher, okay, maybe we want to sell it at a better price up at 1461, we want to then left click in the red. Notice how I created a sell limit at 1461. Again, you're saying the market has to come to me, has to get up to 1461 before I want to get short. You're guaranteed your price, okay? But the execution we know now is that it better trade to 1461.10 before we're guaranteed a fill, okay? And then conversely, okay, if the market's at 1459.70, okay, and we want to place a protective stop or we want to maybe an entry below the current market price, we right click. Okay, we right click in the red and we create a sell stop. Okay, it could be a protective stop or it could be a new entry. Okay, either way, right clicking in the red or right clicking in the green will create a buy stop or a sell stop. It's a right click. Okay, that's where sometimes the confusion comes into play. Okay, left click limit, right click stop. Okay, all right. So we went inside the DOM, we created some buy stops and we buy limits, and then we took both the buy and the sell side. So how does it relate to CFRN and in the training room? Okay, here's what's happening. Okay, we're in the training room, all right, and on occasion you're going to hear Michael start calling out the highs and the lows. Okay, it's calling out the highs and the lows. So what he's doing is this. Okay, let me take it a step back. Okay, when all the rules apply, okay, when all the rules apply, okay, these rules, when the market is trending, okay, when step 1, 2, 3, when they're all in play, okay, the only thing left to do is go inside the DOM and take action and execute, right? All right. So when it's time to take action, there's two ways you can do it. We just outlined it. Number one, you can wait for it to qualify. What does that mean? We know that the market, the normal thing for the market to do is to gravitate toward the BBC, right? This is normal market action. We can wait for that market to get all the way down to the BBC and close in the direction of the trend, okay? We can wait for that candle to close, then go inside the DOM and left click. That's one way to do it, okay? The other way is what Michael is doing sometimes in the training room. When this candle is forming, Okay. He's starting to call out the highs and the lows. Okay. And because we're on a 4-tick range chart, and we know that the height of each candle is going to be 4 ticks in height, he can be proactive. Okay. He can place the order now on a stop. Okay. And this is where the trickiness comes into play. Okay. So all the rules apply. We're looking to get long. Okay. And this candle is forming in real time. Okay. And if the low is 1459, we know the high has to be 1459.40. So in order for the market to print a new candle, it's going to have to print a 5th tick in order for this candle to print. Okay? So the formula is this. Take the low or the high of the current candle and add or subtract 5. And that's where you'll right-click in the DOM. If it's a buy, you'll be right-clicking in the green. If it's a sell, you'll be right-clicking in the red. Okay? Add or subtract 5 ticks from then the current high or low. Okay? And that'll get you there. So let's see if we can't find something real quick. All right? To kind of put this in play. Okay? So like here, for example, we had the bearish cross there, and then that's a bad example. Right here is a good example. We had the bullish cross in the crude. The normal thing for the market to do is to pull back to the BBC. We know to draw a trend line when that happens, right? Because we never know if it'll get to the green line, okay? It does. It does in this example. Okay, now as this thing is forming, and then we have the divergence down below. The cycle is blue, and the green line is pulling away. That's what I mean. All the rules are in play. Okay, so now it's just a matter of taking action. So 2 ways we can do it. We can wait for this candle to close, go inside the DOM and left click. Or while this thing is trading back and forth, back and forth, back and forth, if we know the low is 56.76 even, then we know the high has to be 80. So the low plus 5 is 81. We would then right click at 56.81. Okay, add or subtract, then the current high or low. Okay, and then that'll be the magic number you right click on. Okay, like this example here. This is more of a bearish setup. If we know the high is 56.78, the low has to be 74 because we're on a 4-tick range chart, right? Take then the high, 78, and subtract 5. Right click at 73. Okay? So why would Michael want to do that? Okay? In the event that the market does one of these, it prints the 4th candle and it just takes off, right? It does one of these parabolic moves up, right? Then everyone's looking around and questioning, how did Michael get in this? How did he place the order? I didn't see him do this. That's his way of being proactive, okay? As I said earlier, there's 2 ways you can do this. Wait for the candle to close in the direction of the trend and left click, okay? What did we talk about? Limit orders. Limit orders aren't guaranteed, right? So you risk the chance of missing the trade. Or you can be proactive while this is forming in real time. And the fact that you know what the high is, okay, then you know exactly where to place the sell stop, okay? 5 ticks below then the current high, okay? So that's why we're doing it, all right? So again, in review, if you're going to be getting long, there's 2 ways you can do it. You can left click and create a limit order, or you can right click above the current market price to create a stop, okay? And conversely, if you got a sell signal, you can again left click at the current market price, or you can right-click under the current market price and select and create a sell stop. Okay. And like I said, the risks in doing that, as I just outlined, if you place a limit order, not guaranteed you're going to get filled. However, with the stop losses, whether you're buying it on a stop or selling it on a stop, the price is not guaranteed. And that's called slippage in our business. Generally speaking, when things are normal and not moving fast, a tick or two a slip is the norm. Okay, so I would count on that as being part of your trading plan. Okay, so I hope that help defines what is the differences between a limit and stop and how to place the orders and how they relate to CFRN in the training room. If you have any questions, okay, you can call me at the trade desk at 866-928-3310, 928-3310, or you can shoot me an email.